If you leave all of your hard-earned savings just sitting in cash, you are slowly burning your own money. As the cost of basic goods creeps up week after week, that static pile of cash buys you less and less. Keeping your money uninvested is a guaranteed long-term loss. The standard advice to outpace this slow drain is to put your money to work in broad market stocks. But broad equities leave you exposed to a completely different threat. When systemic panics hit, standard portfolios can lose a massive portion of their value in a matter of days. This puts you in a brutal position. Hold cash, and you die by inflation. Hold broad stocks, and you face the terrifying volatility of a market crash. So how do you actually play defense without sacrificing your long-term wealth? Look at this comparison. Traditional portfolios try to walk the middle ground between the steady upward slope of inflation and the violent, unpredictable crashes of the stock market. Walking the middle often just means taking damage from both sides. True protection requires pairing a highly liquid safe haven asset with an aggressive, out-of-favor recovery tool. Specifically, we need to look at gold exchange-traded funds and Contra mutual funds. To see how they protect your money when combined, we have to tear down exactly how they function on their own. Gold ETFs are essentially paper gold. They track the price of physical gold directly, completely eliminating the need for you to worry about security, insurance, or storing heavy bars in a physical vault. Gold serves a very specific purpose. When global markets panic and other assets freeze, gold acts as an immediate liquidity hedge. You can sell it instantly. This chart shows historical percentage returns of gold compared to treasury bills and the US dollar. Look at 2007 to 2008, and again in 2019. The gold allocation dramatically outperformed the US dollar, preserving capital when fiat currencies lost ground. This graph tracks total gold ETF connectivity. During the severe uncertainty of the pandemic window from 2020 to 2023, you can see a massive spike in volume as investors rushed into gold to protect their assets. But gold has a severe limitation. It generates no economic value and pays zero interest. When central banks raise interest rates, gold prices typically drop because investors migrate to bonds that actually pay a yield. Gold ETFs are highly effective at shielding your purchasing power during an immediate crisis, but they will not compound your wealth for tomorrow. This is where Contra funds come in. These are mutual funds managed by contrarian investors who deliberately buy ignored, heavily discounted stocks during widespread market sell-offs. We can map a stock's actual market price against its theoretical intrinsic value. When panic hits, the market price plunges below what the company is worth. By purchasing these discounted shares, Contra funds capture alpha, returns generated by buying a good company at a terrible price. As the market eventually recovers, that crashed price line corrects upward to meet the intrinsic value, capturing a massive return on the way up. This performance data illustrates rolling historical returns over different timeframes. Notice that a 100% positive return rate only appears in the 7- and 10-year daily rolling windows. This strategy demands extreme patience to actually work. That is the trade-off. Contrarian investing almost guarantees severe underperformance in the short term because you are buying what everyone else is aggressively selling. To see the benefit, you have to commit to an unbreakable 5- to 10-year hold. Contra funds are a powerful engine for building serious wealth a decade from now, but they offer absolutely zero emotional comfort during a present-day crash. When you look at this comparison matrix, you can see how putting them together creates a defensive barbell through negative correlation. You pair an asset that thrives in panic with an asset that buys the panic. Where the Contra fund locks your money up and tests your nerves with high short-term volatility, the gold ETF remains completely liquid and stabilizes your balance. If we plot these on a risk-return matrix, gold sits firmly in the low-return, low-risk corner, while the Contra fund dominates the high-return, high-risk quadrant. By holding both, your overall portfolio balances out right in the middle, lowering your total volatility. There is a cost to this balance. Because your gold allocation won't soar during a raging bull market, it will act as a drag on your peak returns. You will not beat an all-equity portfolio during a massive rally. But the goal of this barbell isn't to chase the highest possible peak. The goal is survival during the drops, paired with consistent, compounded growth over the long haul. The exact ratio depends entirely on your timeline and anxiety tolerance. For conservative investors, a large gold allocation, say 15 to 20%, acts as a massive shock absorber. The Contra fund serves as the satellite allocation for growth, keeping you from panic selling. This investor accepts a slightly lower 10-year return in exchange for immediate psychological peace of mind when the market drops. For someone focused strictly on wealth building, the roles reverse. You build a massive core of Contra funds through regular systemic investments and keep only a tiny 5 to 10% sliver in gold ETFs to act as an absolute emergency buffer. Regardless of the ratio you choose, the barbell structure means you no longer have to choose between playing it safe and taking reckless risks. Leaving your money in cash guarantees a slow loss to inflation. Going all in on broad equities exposes you to devastating volatility. The defensive barbell solves this. Gold is your shield. It preserves your immediate liquidity today. Contra funds are your sword. They secure your aggressive growth for tomorrow. By aligning these two opposing tools with your personal timeline, you build a structure that prevents emotional mistakes when the market eventually drops. True financial safety isn't hiding from the market. It's being structurally prepared to capitalize on whatever it does next.